not a startup per se, but I had a lot of transformation. We had done a lot of transformation, almost like a startup, a company called CSS Corp. One thing was continue to learn as I kind of checked my way through the corporate world. I've been very fortunate enough to have a lot of good experiences and exposures as I went along. I've been part of close to about 12 M&As, mergers and acquisitions. On both sides of the spectrum, I've been on the buyer side, I've been on the seller side, so I was able to understand both the viewpoints, and has been part of organizations that had to deal with private equity investors and raise funds or kind of change financial or strategic ownership in the past. So that's been my experience so far, and once again glad to be here. And what I want to start, of course, right, and then I know you guys can kind of prompt me a couple questions, etc. I mean, as against finance, right? One thing I want to do as part of this half-an-hour chat is to demystify finance. Right? I know you guys know about product. You guys know what you are building, right? The problem that you are solving, right? And ultimately, how to kind of take to the market, the branding, etc. And one of the important components of running a business obviously is finance, right? And like Chapan said, right, that's a whole purpose, right? Beyond the building businesses, right? You solve a problem, but at the end of the day, you have to monetize your solution, and that's where finance comes in. And I want to kind of demystify this whole finance part, right? There are multiple sections or multiple facets of what finance means, right? One can mean pure accounting, right? Which is very transactional. Is it not important? Certainly, you know, it is certainly important. Because ultimately you will have to keep a track of how much you earn, how much you spend, what is your profit, how much is your cash. And by the way, I mean, that's the mantra that all CFOs, right, will say to you, right, irrespective of what stage your company is, what stage your venture is. Cash is the key, right? So to keep track of all this, you need accounting, and that's probably what I would call as one of the founding or the starting bricks of finance in an organization, is to have a good transactional accounting done, right? That's the first thing. The second one comes in the way of, and this is where finance aligns itself closely to the business, right? While accounting talks about how the business is doing, it's pretty much post-mortem, right? Okay, yesterday I earned this much revenue. Last month I earned this much revenue. Last month this much was my profit, and this much is the cash that I have as of today. It's always post-mortem. But then there is a point in time that finance aligns itself to business, and that's when finance matures to the stage 2, as I call it. This is more what we call a business finance, management information system, or right, strategic finance, like you might any name you might want to call it. And here, what happens is finance has to identify, along with the business, right, as to what are all the key metrics that needs to be tracked. And these metrics have to be tracked so that it kind of acts as either a lag indicator or a lead indicator of how the business is going to do or how the business has done, right? So, for example, right, suppose if you are running say a B2C business, right? B2C business of, I mean, let me take from one of my friends' example. Like he runs IVF organization, IVF care, chain of hospitals, right? For him, one of the lead indicator of how the business will do is what is called as a TFR, the total fertility rate, right? He obviously, as a businessman, has to kind of track the TFR, right, whether in the locality that he operates in or in the whole country, India, as the case may be, right? So TFR is a key indicator, right? If the TFR is low, for example, that means, right, there is going to be requirement, there is going to be people that will come to IVF, right? And his business. This is a lead indicator for his business. Similarly, right, I was working as a CFO of a mortgage technology platform, and this specializes in the residential mortgage industry of the US. Right there, and one of the products was a technology product which helped people when they default their mortgages. Right, US, the mortgage industry is highly regulated. So what happens is if you default in a mortgage, you take a home loan and you don't pay, there are a bunch of documentation, statutory that the lender has to do, the bank has to do, and same way the borrower has to do. And all this is taken care step by step, making sure that all the regulations, and the regulation can vary by state in the US, right? There are about 51 states there. And this technology helped the lenders as well as the borrowers to take care of that, right? And for that, one of the lead indicators for our business, the product business, is that how is the interest rates are rising in the US, right? So as the interest rates rise in the US, there is going to be default increases. And as the default increases, demand for my product is going to be higher, right? So it is a little, what I was saying, morbid. We used to say it's a very morbid business, right? You are betting on how bad the US economy is going to perform. That's how it's like, right? There are certain things where you bet for the economy, there are certain things you bet against a certain country's economy, but that's the nature of the business. But the point here is the interest rate in the US becomes a lead indicator for my business, right? So that's where finance comes in, where I work with the business to make sure that identify lead indicators, identify lag indicators, to make sure I get a fair forecast of how the business is going to be 1 year down the line, 2 years down the line, 5 years down the line, not even going that far, even a quarter down the line. Because once we all scale up and become public companies, right? Every quarter we'll have to give forecast to the investors, and all that will come in only if you understand the business properly and if that is aligned with your financial forecasting mechanism. So that's the second stage of corporate finance. And this third stage is where a lot more strategy comes into play, and this is where it involves, right, either you go in for an M&A where you acquire organization, or it can be even divestment. And I myself have been part of two important divestments in my business, where we thought that this line of business is not core for me, right? This is not take the core business to where I want it to be. So we had to end up divesting the business, selling off the business. Chetan was also saying, right, working with investors, where it can be part of fundraise, it can be part of a strategic acquisition, where my business itself gets acquired by a bigger company, right? Working with the investors becomes the third part of the strategic finance. So these three are what I think, as the organization matures, as the startup matures, right? This is a path like your marketing goes through an evolution, your branding will go through an evolution, right? Your people practices will go through an evolution. Finance practices also go through an evolution from basic rudimentary accounting to reaching strategic finance. So this is pretty much what I see as a journey, right? And I'll just stop here, right, to prompt you for any questions from here on you guys.
So, this is a question to the team. How many of you actually have a financial person supporting you? Okay, there is one Zillow who's got someone supporting them. Anyone else? How many people have actually made business plans yourself?
With the help of CA, we did it.
Yeah. And how many people have budgeted a payroll for CFO?
In the business plan, yes.
So, when should we actually start looking at finance from the start? At an ideation stage, at a product stage, or at a group market stage? When do you really think we should focus on that?
Very good point. So there are three ways that I think of, right? One, right, of course, finance will be an undercurrent, an unseen thing in all of this, right? Even at an ideation stage, or even at a stage where the product is not monetized, it's in the product build stage, right? You still need to monitor, right? There is going to be effort, It can be a person's effort, it can be a team's effort, right? There is going to be certain amount of effort that goes in building that particular solution, that particular product, right? And the requirement in this stage mostly comes from the investor. It can be you, right, who I'm investing in my own product. I need to know how much investment I'm going to make, right? How much cash I'm going to put in, and how much and what is typically called as cash burn, right? How much cash I start burning till I'm going to see some monetization, right? That's one. So finance starts pretty much on day one. We might not calculate it that way, but it will, as I said, right, it will always be there as an unseen thing. That being, right, the more important one is, especially with respect to investors, right, the longer it takes, the gestation period, right, it helps them not to, the investment, they will not want to cut short the investment or whatever, but it will help them to understand, right, if they need to rope in a bigger set of investors. Like for example, solving a problem. That's as an example, I do not know exactly which is, but I say for solving X problem, you might need $1 million. But solving a problem Y probably might need $100 million. The investor subset in both of these things is going to be much different, right? So that's where you need the ability to kind of understand how much the investment will take, and what is going to be the cash burn, how long it's going to take, and all this is finance. Ultimately, right, it will all fall within the purview of finance, right? So that's the answer. And as I said, right, when you start earning that $1 in revenue, that's when the accounting takes over, because that becomes very important for you to, on an ongoing basis, record and understand how the business is doing, right? It's like a health check, right? At the end of every month, at the end of every fortnight, at the end of every quarter, you will have to know as an entrepreneur that, hey, okay, my business earned this much, right? I spent this much. This is my profit, loss. I continue to burn cash, or I am becoming cash positive, because that point in time when startups change from cash burning startups to cash positive is a significant milestone in any startup's life, right? So for you to track off it, it has to be accounting. So the accounting, etc., takes over from day one of revenue. But having said that, as I said, day 0 and before, it is certainly accounting or finance is needed for an investor to know, right? The prerogative is different, the priorities change, but nevertheless, it is, in my mind, is a need from day one. Right? As an accountant, I need to sell my wares, right? So that's why I'm also saying in the day plus. From day 0 or even before that, accounting, finance is important.
So, as a startup with restricted cash, can they afford to hire a professional consultant? A chartered accountant firms. These are expensive, right? I think most of you will be wondering, is it really worth spending that money on them? Do I need to at least maybe a law firm managing my existence with restricted cash or zero cash?
Absolutely.
How do they balance?
Absolutely. Very, very important. See, once again, right, like it or not, see, one, accounting or understanding the business, that is not for anyone else, right? That's for our own business, our own purposes, right? If you are good with numbers, if you have some rudimentary understanding of accounting, there is always, I'm sure all institutes, management institutes also teach accounting or finance for non-finance professionals, right? So it will come with basic understanding, right? You might not know what a debit credit is, etc. But then you understand revenue, you understand cost, that's more than enough. So probably you might not even need an accountant. And there are, of course, like a lot of products that are there, right? Good cloud SaaS products that are available right now, which do not cost a bomb, that can add value in terms of the basic rudimentary accounting. So that's fine. One thing that might be a kind of a minefield, in my opinion, is regulatory compliances. See, what happens is, especially in a country like ours, right, which is still evolving, an entrepreneur, as he goes through this journey, has to face lot of regulatory challenges, right? The more, in fact, if you are cut off, if you are a B2B kind of a player, right, the regulatory framework is different. If you are a B2C player, the regulatory framework is different. I mean, I was just reading this one, I think this is from a book by a famous author, right, where he says, for example, the excise department says that a restaurant can have only one door, okay, but actually the fire department says any restaurant or any enterprise like this, any building has to have two doors, one for entry and one for escape or one for fire escape. In a regulatory thing like this, right, I mean, you will obviously go wrong somewhere, right? Either you are wrong with the excise department or you are wrong with the fire department. So you need certain level of expertise to kind of wade through some of these challenges depending on the requirement of the business, right? So the one thing for all of you guys to understand is how much regulatory framework is needed in your particular line of business, and accordingly to that extent, I mean obviously that it is a, I would say it is a needed, much needed evil. I mean, you need to spend, but do you need to spend on a full-time person or whatever? Not necessarily. I mean, right now, to some extent, these services are commoditized. Right? There are a lot of companies that offer what they call as either CFO bridge or whatever it is, where there is no requirement for startups or smaller organizations, SMEs, to have a full-time CFO or a full-time compliance person. To some extent, all of this can be outsourced. So, but there will be a cost. You know, to answer your question, there will be a cost, but then that cost can vary depending on the requirement as the need from a business. Ultimately, business will require or will dictate how much regulatory compliance is needed, right? So, but that is a necessary evil. But it might not be nowadays. I think there is a fair bit of ecosystem that has developed where it can be done with plugging in resources from some of these consulting agencies.
So, I mean, most of the startups here are at a pretty early stage, right? And even at that stage, they're obviously getting a lot of angel investors, they're probably getting Series A investors, pre-Series A investors. So, what I want to understand from a CFO perspective is when these companies go and pitch, there's an entire board of investors who are sitting and making that decision whether or not to take this company or not. So, in terms of the estimates or the projections that they present as a part of their plan, what are the metrics that you look at? Obviously, you can't look at unit economics at this stage, you can't really look at a lot of strong metrics that probably would be present in a slightly bigger company. So, what do you look at this stage?
Super, yeah. So, yeah, very, very good question. See, the point is ultimately, I think, what investors will be looking at is two things, right? One, what is the problem that you are solving, right? How do you intend to solve the problem? And what is ultimately we all, I mean, investors call it in their lingo as total addressable market or TAM or whatever it is. But what that problem solving will mean in terms of the potential of this business to grow. Currently, what is the ultimately the TAM is nothing but the estimated size of the problem, right? And that, in my mind, is a necessity rather. But the point is, at a very, very early stage, this also came across in some of our conversations, that we intend to set out solving a problem. There is a specific product, identified product strategy to solve that problem. But we may not even know what are all the other use cases that might be there. Because ultimately the TAM also get defined by the use cases, right? The more use cases, the more TAM, right? So in a way it is restricted, but I think investors will at least need the clarity in terms of what the current team is thinking, right? In terms of the problem that the team or the entrepreneur is solving, what he thinks the current TAM is, right? And how that is very, very important. That's one. The second one, you were asking about unit economics, it's very difficult. I think I agree with it. I think it might evolve also. Right? It need not be on, I would say, pitch on day one that you need to do about day economics. But I think it might help if, as you anyway see, there's always a fair bit of forecasting that you do, right? In terms of how the business will shape up, right? As part of the forecast, somewhere around the line, I mean, whether it can be 1 year down the line or 2 years down the line, what you think currently has to be the unit economics, right? Because that will add a lot of power into the pitch, is my opinion, right? And and ultimately, see, there are two things that you address because of this. One is because of the TAM, you also that defines your GTM, go-to-market strategy, and the unit economics will also make it very, very clear to the investor that is these entrepreneurs do think about finance in a better manner, right? Because that will ensure fiscal discipline, right? If you are very clear about how your unit economics has to shape up 2 years down the line, that means that you are trying to put up that fiscal discipline from now on. It's not going to jump to you on step 2. So I think it's better to know that. See, even if it's a little bit forecasted, you can always put in a lot of assumptions. You can put in a word of caution saying that this is what we think might change, right? But I think
Right now, there's so much confusion that earlier, unit economics was just one of the metrics that you see, but again, like in a lot of sectors, it was not that specified. But now there's a lot of question and because of funding, but as we see, that why are investors looking at funding? So,
to my mind, I think it's always it's one of the basic criteria. Right? I am from services industry, and I have ventured into tech products a little bit, but most of the time in my last 2 decades I've been in the services part. But even in the services industry, right, ultimately we define unit economics by what we call as gross contribution or gross margin, right? Where we take the revenue, take all the costs that is needed to earn the revenue, other than sales, marketing, general management, finance, etc. Right? So there is unit economics at play, right? And this has been from day one, interviews, etc. have been in the investor calls talking about gross contribution or gross margin for ages now, right? I think this was in this whole fear of missing out funding that happened in the past or in the recent past. This was kind of miscount to be seen as a basic hygiene. And now I think all those principles are catching up. So that's why I think when I talked about accounting, when I talked about some of the building blocks of finance, right? See, the basics will never change, right? Whether it is unit economics, whether it is cash, ultimately cash generation, cash conservation, etc. The basics will continue to be the same. That's how you set up a strong business that can weather all storms, right? You can forget the basics, but then we all know what will happen. Then you are only catching up with the trend. We will be there. You will be part of the trend for some time. And you will lose focus. You will lose favor, and that's not what we all want to do. Right? It has to be an all-weather business, and for that, the basics are always the same.
So most of us are engineers here, and we have like absolutely zero or maybe negative knowledge in finance and commerce. So what should be the roadmap, or where should we start? Is there any book that you recommend for us to start the commerce?
I don't think I think of a very singular book or whatever. But I can see, now most of this knowledge is available in the internet itself. Right? I would say one thing that you might still want to understand is the basic principles. See, ultimately, the finance itself is built on the concepts of accounting, etc. In fact, one of my friends was telling me that he runs the CFO bridge kind of a shop, right? That does CFO services to a lot of startups and SMEs. He recently was touring across in the US. There, the US, where we think that the startup ecosystem or the finance related thing is much mature. He says even there, lot of startups do not know what is the concept of accrual accounting. They still do everything in what is a pretty much a very bad system of accounting called cash accounting, right? You spend cash, that's when, or you earn cash, or you get cash, that's when they book it as a income or revenue or whatever it is, right? So there, obviously, the accounting has to start with accrual accounting, right? Where you deliver a product, you deliver a service, and then you say that, okay, now that I delivered the service, this is from this day, my revenue of $1 is going to start. The customer might have some time to pay as per contract, you will pay after 1 month, right? But then I kind of start recognizing my revenue or accruing my revenue on day one. So even this is a basic concept, right? So some of these principles are pretty much available, off the shelf on the internet, right? And it's not very easy. I can understand accounting, I'm sure Grace can understand accounting very well, right? So that should be the basic thing. One of the key things, as I said, is that I do not know whether this college has it or one thing is there's always this encapsulated systems that are done for finance or non-finance professionals, right? Which kind of is a proven thing. Everybody goes through it. And even in corporate world, what we do is at various points in time, in the service industry where I was, right, techies who join us as coders, etc. At some point they become project leads, project managers. Then they start owning P&Ls, right? So they have to have the understanding of accounting and basic things of finance. So just over 25-30 slides, right? All that yarn is given and then the bulb starts burning, right? So it's easy. It's not rocket science anyway, right? It's fairly easy. I think regulation or compliance is one thing which everybody has to tread very carefully, and that's something that better to use experts. For concepts, you can, as I said, right, it's easy to get. The transactional accounting per se, that's it's very transactional, and you have to obviously do what I don't think, I would rather have you guys build product and look at the technology there, the technical debt, etc., and solve those issues rather than look at accounting. There, I would suggest a lot of off-the-shelf SaaS products are there, right? So anybody with a basic BCom degree can help, and that, as I said, those services are also available on a part-time thing now, right? But then you need to understand. See, the point is, an entrepreneur like you ultimately has to understand the lingo, so that if that accountant comes and tells you at the end of the month, saying that, hey, this is my revenue, this is my cost, etc., you should be able to discern whether it is in line with what how the business is doing, whether the underlying basics are correct, etc. Right? So that's where you need to have an understanding. You need not to have a deep understanding of accounting. And ultimately, it will be a highly specialized and a highly transactional area. Does that answer your question?
Thank you.
So you were working with CSS Corp. I know CSS Corp. It's a lot of can you just tell how many people are there in CSS Corp?
Right now, it's about 12,000 people globally. Right?
You want
another question?
So my question is, how do you manage such a large organization? I think most of us are 3 people, 4 people, startups. So these startups, how can they see themselves managing such a large organization? And I personally, I don't want them to manage such a large organization because they are supposed to be deep tech startups. It's very restricted number of people. But still, how do you hire right people? How do you hire the leadership team? How do you set up your organization?
So one thing, once again, a great question. Luckily for me, at least I can talk from experience that I've been always part of companies that started small and grow big. For example, even when I joined Cognizant, most of you should know Cognizant. Right now it's almost a $15 billion with close to over 300,000 people worldwide, etc. When I joined Cognizant, it was less than 2,000 people with having revenues of less than $50 million annually. Right? From there it grew, and luckily most of your experiences kind of mirror that where I joined organizations when they are fairly small, and and then kind of scaled up. I think one of the key things is define. I think you guys have the advantage also because you are starting afresh. You have the advantage of defining the corporate culture at the fairly young age or fairly young stage, rather. Because that's what defines an organization. And I've seen successful organizations like Cognizant become successful basically because they got this corporate culture very, very right. Because they do have to say that, okay, I will only hire, right, good people or A players, right, who are top in their respective jobs, right. So no compromise on quality, right. And you kind of bring the right people in place, right. So that itself is job after. Because you bring the right people for the job, then the organization kind of finds its way. That's one thing. The second one is the more important thing is also bringing the collaborative culture from day one, right? When there are more than 3 people, we all say, right, the 3 is a crowd, right? When there are more than one person, there is always going to be a different sort of opinion. The most important thing is defining a culture where how conflicts are handled, right? It's not very easy, having said that, right? There is no specific playbook for that. But having said that, I think the ultimate mantra has to be, okay, and we all decide in consensus that we debate and then decide that this is the decision. Ultimately, each one, when I walk out of this room, right, even if he feels that, okay, that decision is not something that he believed in, because it has been now decided on a consensus, he will stand by it and then work towards it, right? I think that is, in my mind, a significant differentiator when it comes to organization. Because what happens is, when everybody stands by that decision, everybody stands by that goal, then it becomes easier. And more important, I think what will also happen as you grow is to find specialists. I think this is where it becomes important, right? You hire the right kind of specialists for the right thing. Initially, we all can do, marketing, right? We can all do HR. When I say HR, it's like, right, you are starting from being a 3-member team to a 30-member team. The initial recruiting, initial thing you'll have to do. In fact, it's important that you do because that's when you are bringing the right kind of people into the organization. But then, from going from 30 to 3,000, if you expect to do the same thing, it's not scalable. It's not going to be possible. Then, the important thing is to kind of put the right HR organization in place, right? To make sure that the talent acquisition has these guardrails, right? You have developed those principles, guardrails, how the talent acquisition has to happen in the organization, and the HR organization follows that. I think that's how to kind of scale up. Because, so once again, it is, there is no, every organization at various stages fails or succeeds. Right? For example, I can go from CSS experience, just to kind of rewind a little bit, right? CSS was 10 years back, right? It's a startup, like what most of you guys aspire to be. It was started by 2 first-generation entrepreneurs out of Chennai, right? Specialized in mostly in consumer tech support space, right? And it grew to become a $80 to $100 million company in revenue, right? And then it had the marquee investors lining up to invest in that company. But along the way, what happened was, and at that time it was about 2,000 people, right? But along the way, for about the span of 6-7 years, it lost its way. When the revenue stagnated, the company never grew. In fact, it started degrowing. But then there were, starting 2017, right? There were, kind of a bunch of folks we got, kind of looked at how the business can be transformed. And then now, from the $100 million in the last 3 years, it has grown to $250 million. That's 3,000, 4,000 people has gone to 11,000 people. But is there a simple playbook for all this? Not really, right? But how did we do it? By sticking to some of the basics, right? The first one is the most important thing is about people. Being in the services industry, ultimately it's going to be about people. So, in the pandemic year, when all the companies across the globe, leave alone India, were postponing annual appraisals and increases, CSS was the first company out of the block to come and say, we will continue to do our annual appraisals and increases like what we do regularly. That was like a better year for everybody. And also, the variable component or the bonus was paid up on time. And that's one thing. The second one was the employee well-being, health, etc. CSS was one of the first companies to make sure that the work from home, the Prime Minister announced the national lockdown on March 24th, right? March 25th, not even one soul was in office, right? It was all work from home. And believe me or not, we did not even face disruption or our services to our end customers, right? Because this was done as a very big part of the plan. Luckily, we had a good little bit of a playbook there. CSS operates out of China, where we had about 100 people. That was the first, obviously the first country to go into lockdown way back in December of 2019. And whatever we did in that, for that country, we took that as a playbook. We implemented that in Chennai, India, Philippines, Costa Rica, US, etc. Right? So ultimately, what is important is to make sure that the employees are taken care of. Right? That's the first thing. In fact, that we went against the grain to do that because the company was itself facing uncertainty. We never know how the pandemic year will turn out in terms of the business, in terms of revenue, etc. Right? So that was the basic thing. And believe me or not, the way we handled the pandemic, the way we handled our employees, itself became much more of a calling card for our sales days because we started getting more business. In fact, that the pandemic year, like we grew 25% year on year. And most of it came from existing customers where they pulled up volumes from other of their vendors and gave it to services, right? So that's the employee thing was done, right? The second most important thing is, of course, right? That's where I come in, the cheap finance part, right? One thing that we did very, very well was to make sure that the entire cash management was done very, very well, right? In terms of how do we conserve cash, how do we maintain cash, etc. During COVID, before or after COVID, and that, of course, making sure that the unit economics that I talked about, the gross contribution, the profitability of the company stayed intact, right? And we were able to exhibit that, and that became great success in the transformation. And more importantly, see, as entrepreneurs, please remember, I think this is also, I thought, as an important advice to entrepreneurs like you, that you also know when to let go. Suppose if you are building a suite of products, right, 2 or 3 of them, right, in that, you might be still emotionally attached to one of them, right, it might have even scaled up, etc. But at some point in time, you might find that it might stand in the way, or it might not align with the rest of what your core product is, right? And this might not align, right, in terms of the investment thesis, how it will go, right? The product might not fit into your overall roadmap. You should know the right point and let it go. Because in fact, that's what we did with CSS also. 10 years back, CSS acquired a networking services company out of the US. In fact, it was, for most of the time, it was growing in revenue and actually contributing to the profitability of the company. But believe me or not, in 2020 we thought that that company is going to be a drain because high touch, high management bandwidth sucking company, right? The margin profile or the long-term margin profile of the business is going to be much lower than our core business, right? And so we want to let it go, right? It was a tough decision, but as entrepreneurs, we do face that kind of decision, right? And we have to take that path. So I think that also was a thing, right? How CSS transformed itself on that. Sure that the company does not lose track of the unit economics or see ultimately, right? The product or the service strategy notwithstanding, what happens most of the time see, ultimately, believe it or not, the success or otherwise of any business ultimately get measured by money. It's all measured in monetary terms, right? And to that extent, we have to stay focused. Any business has to stay focused on the financial metrics, right? The outcomes of staying focused are profitability, growth, etc. But the path to that outcome is your discipline on maintaining fiscal discipline, right? The fiscal discipline are nothing but making sure that the unit economic stays same. Like for example, as a services company, if I slip out of the gross margin or the gross contribution of that 40%, and I keep slipping them to 30%, maybe in the short term I will get more business because I will be undercutting myself, I will get more business. But then in long term, my business is going to get struggle, right? That's one. The second one is more important, capital allocation. See, where do you allocate capital? Ultimately, I'm sure by this time, all the basic understood that the most difficult resource, right? So you have to allocate capital, and that's why I said, right? You also need to be wise enough to understand if you need to switch off a particular area, or switch off or divest a particular part of the business, etc. Right? So that is where finance is coming. Right? For example, I think the decision of CSS to kind of divest that business, the networking US business, was a great decision. Right? That's one. Capital allocation does not actually mean that you cut off something, because it also finance has authority of saying, hey, you know what, finance you do, you'll say, ask me not to spend. Right? But you should also know when to spend on what. Right? In fact, CSS did an excellent, those CSS is a PR based services company. CSS, just before I left, that was one of the last things that I did for CSS. We acquired a product platform called Alumnus. It's a product, obviously, it overlays services on the product. Without the services, the CSS will not touch it, right? Because it's a service company. But On Demand is a company that actually was promoted by Microsoft Ventures in the US. It was a very successful product. I mean, what it does is that it takes the power of the part-time or gig workers and puts them onto the platform so that you have a bigger pool of customer representatives. Right? So, see, just to not take a lot of time, but to simply say what CSM does is, suppose if you have a problem with the iPhone, right? You call a customer service number, you call 800 number that is given to you by Apple. In most of the cases, that call will happen in the company like CSM, right? Where the customer service executive will help you solve the technical problem. Right? It should be a technology product problem. It is not like you say, hey, my phones are these rows. Then you will say, what do you do? I mean, you will have to do all these things to one feature or whatever. Right? So that's what we do. And most of the current model is around having, right, if I try to service Apple, I have to have 100 resources. I'll have to take 100 people on full-time payroll, right? And then wait for volumes to come from Apple. If there is no volume, I don't take revenue, but I still have to pay the other people, right? Because they are on my payroll. But this platform, On Demand, what it does is basically, if I am an expert, right, in Apple, and I have some certification because I don't want to work for that. I'm in San Diego, right? I'm working out of my home. I can hook up to the platform, and if Apple gives a problem to CSS can use the platform to give that problem to this gig worker in San Diego, and he gets paid by the hour or paid by the problem that he solves, and it becomes a variable kind of a proposition, right? You get something, you pay him, and the company keeps certain amount for enabling this whole thing to happen. Right? Then the company avoids fixed cost. For Apple, the problem gets solved much faster because he has a much bigger pool of experts that is available. And for the expert, I mean, he has time, he uses his time wisely. I mean, he wants to work on tournament and then go for skiing, right? He does it, right? So he works for everybody. So this is a tech platform that we have acquired. And talking about that, it's a capital allocation problem for me, right? So I have a finite amount of capital with me. Should I go and buy this product? So what will help me buy this product? So how this product? So then I have to evaluate like any other startup, right? On demand was like any other business model. So hey, what is the problem that they are solving? What is the total addressable market? Right? And what is the India? Right? What is the current P&L cash flow? Forecast how it is looking, right? Is it viable? Right? How many clients that they have? Right? How many contracts that they have? Right? So it becomes a then capital allocation. So it is a bunch of this thing, right? One is fiscal discipline, right? Capital allocation, both in terms of investing in the right thing and not investing in the wrong thing, right? Are very important. Last but not is cash, right? Ultimately, any business that is part of business, we have to conserve cash. Because cash, as I said, is the key. You can sell something, right? You can raise an invoice, you can deliver a product or a service to somebody. At the end of the day, he does not pay, right? You have lost cash. But you will have to still pay your employee, you will have to still pay for your efforts, you will have to still pay yourself, right? But the service that you have delivered or the product that you delivered are not delivered. So cash conservation, the whole working capital cycle, that's where right finance plays a very, very important factor. So we are talking about pay. When does the founder take responsibility? When should he actually have money from the thing? Yeah. It's a very tough question. See, the point is, the point is the founder thing, the why normally founders do not take it. One is, of course, right, the want to first solve the problem that's something, and obviously you are trying to investors and all that there. But more importantly, right, we should not distort the underlying unit economics or viability of the product. That's why normally founders, right, and it's a cash conservation, mechanism, right? When we take, I think there is no exact right answer. I mean, in the service industry, I don't think that they should take it much faster because what also happens is investors, and I'm talking to investors, that when we look at the overall economics of the venture, we also factor as deemed, I mean, even if you have not taken any fee, etc., there is always a deemed, I mean, if I have to hire somebody from the market, right, some expert to do this, right, what they will take, right? There is always a deemed. So in a way, it does not come in the way of valuation. It is more of a cash conservation mechanism. Right? As if you start thinking that you have to break even cash or earning cash positive, you should start with that. Either way, if you want to valuation.
I'll start with do I always get really emotional? And if debt, what are challenges?
The debt is cheap, right? Equity obviously is much costlier, right? Debt, well, there are a lot of options, right? Obviously, but the point is finding debt, especially the deep debt, where there is debt always looks for more, what I would say, safe bets, right? There is nothing like a risky bet from a debt perspective. So if the timing of the debt can be once you have there is revenue or once cash positive, then easy to raise debt. That way it will come cheaper. But obviously, equity is what, though it is costlier, that will be the one that will be providing most of the initial, especially from a venture capital perspective, right? But there are some venture debt also. Right? Obviously, comes with a much higher cost. But there are venture debt, they will come with the status. There is a high income. But I would think at any company that can go for debt will be find a reasonable opportunity, and there is a good predictable revenue stream and reasonable cash possibilities in this topic.
Should they take network funding waivers? It's a good thing to talk about. See, debt, right, obviously, one of the key principles around debt is what you use the debt for. Right, see, if the debt is used to kind of build the product and there is a revenue attached to it, there is monetization window that is there. That's good. But obviously, if it is only for the short term, see, for example, deep tech, higher entities, right? I wouldn't know how it for paying salary, but I'll use it for building a product. So there, I mean, obviously, you have to can take it, right? But for example, if you are setting up a office space, right, and most of your debt goes there, then obviously then it is not to get use of capital. Or if you are the debt goes only to service your working capital, right? Then that means you are taking a much higher cost of capital for your capital. Either tighten your working capital or going for much cheaper working capital.
So then, just to add to Sunup's question, right? What's your take on the hybrid model? Right? Since most of our startups are pretty early stage, right? You suggest compulsory convertible debt or a compulsory convertible preference shares kind of a model. I'll tell you the reason. Right? Going in for a price round, right? Say, for example, let me take the example of this, which is one of the happening techs globally. Right? Everybody is talking about climate change and climate intelligence and things like that. But if you purely look at their revenues and tech at this point in time, they may not get that desired valuation. So, would you suggest a hybrid model like a compulsory convertible debt or a preference shares, or which is better, whether it's a debt or a preference share kind of?
Yeah, you are right.
From a structuring standpoint.
Exactly. So, a lot of companies face this specific problem, right? But you are right. I think in this case, one, it might be too early to make a value, and also the point is the valuation might not, or the business or the product itself might not have reached that momentum, kind of do a proper valuation. So, what we call it also as kind of a mezzanine kind of a product, right, where it can be part debt, part financial, right? Or CCD is a much favored route nowadays, right? The only problem with CCD is that there is always this is more from an investor point of view, there is a dilemma, right? I would rather, and especially if it's a promising product, right? I would rather money on it, the current equity valuation, rather than wait for it, and then 1 year down the line it is going to be at a higher valuation at the time when my equity will get converted. So there is a dilemma more from an investor perspective. So to that extent, he might want you to compensate for that time through a fixed rate of return, right? So you might have to pay 12 to 14% during the time when it stays as a debt, and after that, it converts into equity. But yes, that is a generally this is kind of about 18 months to 24 months before you get the next round of valuation. So that is, in fact, a lot of even mature companies do that nowadays. Right, to kind of one avoid multiple valuations, right, and also they think that the valuation can be much better 2 years down the line. So a mezzanine or a CCD round makes sense. But the only thing is, you will have to find the right kind of investor because your equity investors might not be there. Yeah, but there are specialized players.
So, thanks.
So, this one kind of I want to understand, let's say a bootstrap company, it's kind of going well, they're paying their own, but we are still at the stage where we want to expand. It's not exactly that we are cash positive, but they're heading towards it. So, in a situation like that, to have certain kind of expansion would equally be better, would debt be better? Also, how does one come to that decision? Because maybe they could just mean, there are multiple businesses which just will get as well.
So it's equity also because cost. The point is also if it's a very promising business. Ultimately, the owners, current owners, want to buy it. So if you can find somebody with a debt without diluting, that's always a option, right? Especially even you see good potential and good valuation. Short from everybody's perspective, and they would not want to take as much as possible, right? But progressively that becomes costly and difficult to get, right? That's where there, I mean, once again, right, that kind of structure we have because while you know that you are not diluting anything now, you are only getting the at a higher speed, right? So to that extent, there is a value you also get, the current stakeholders get, that's one thing. The dilution will be lesser at a higher valuation. That's the second point. And the third point is for the incoming investor, there is a promise of equity participation of a promising business. But at the same time, he is also kind of recent, he gets kind of compensated through a debt servicing mechanism, right? Through an interest, through the intervening period, right? It kind of win-win for the but like entrepreneurs, they all be to the maximum possible.
Give one more question. Like, until now we've been discussing how to get money from plan for it. So once, let's say, a company has got a certain amount of funding, right? To establish a financial plan, how does one?
So there, I think that's what one. I think once you have taken the debt of it also becomes the obligation of them to make sure that one, not only the fiscal discipline is maintained, but also the investors, whether it can be debt, it can be equity, they also get anyway. And what will happen is either through a board participation or whatever, there will be oversight of the affairs, right? Especially financial. So there, obviously, as I said, once again, repeating what I said earlier, have one of these, not do accounting or Excel or whatever you have a fairly established, decent SaaS product that does that has this accounting structure. The second one is to have some kind of specialism. It can be part time, it can be full time, depending on how your cash situation is, how your profit distribution is. You have to have a dedicated independent accounting team or a financial team. And more importantly, you don't have to over engineer it, especially if it gives comfort to the investor to have an independent audit done. Right? It need not be very, very frequent on a quarterly order, then if you want to do it at least on an annual basis, wait for the independent accountant auditor certifies. Right? But it can be part of regulatory requirement also. But here, what you can do is take it a little bit further, not do it only for the purpose of your company's filing or whatever. Take it a little bit further, and make sure that the external auditor has some kind of oversight where he has a discussion with your board or an audit committee or whatever, right? So that they get the perspective that okay, there is transparent accounting, auditing. The second, more importantly, our planning and forecasting is to fix the underlying metrics that are needed to measure your product, the success of your product and service. Okay, that is very, very important, right? You have to understand this, what defines success in that particular. Then, once you have understood that, your financial information should fit into that. For example, it can be as I said, or it can be the revenue per, I mean, if it's a services kind of where I come from, right? Revenue per resource becomes a very important factor. Cost per resource becomes a very important factor. When I both put together, right? in a product business, right, especially SaaS product business, the recurring revenue becomes very important. Your ARR, MRR becomes very important. What is also important is the non-linearity when your platform brings in terms of revenue, right? How much platform can scale up and how much non-linear is, right? And the annual nature of your contracts, right? For example, your revenue contracts are all short term. It's all 2 or 3 months. You do a project, you deploy a product, you get a product, only for 2 months, and that's it. That might have lesser value or a lesser valuation or lesser investment rather than having a long term 1 year, 2 year, or a recurring contract with your right? So all this becomes the defining metrics of how success has to be measured. To achieve things that really outside of the entrepreneur will go over the investor. Your financial information should kind of flow into that to be able to generate a proper, meaningful awareness. That becomes
so how to achieve this? This is a question that is just taking the industry. Yeah, any tips, any advice?
no, see, I think nowadays, of course, I think people, this realization has gone a little late, right? After learning millions and millions of dollars. People, 6-7 months back, people used to talk about real estate, right? Where you just pour cash just to 6K. I think, see, there will be cash flow, especially new product or new business. Initially, it has to work because, especially in a product, the destination is much stronger. I think that everybody understands the investment, but right, as long as you stay focused on your product roadmap and the various phases in which the demonetization happens, I think it should be fine. Like a cash burn by itself is not a factor. Right? The objective has to be earning cash positive. Exactly. And there has to be a specific roadmap. It can be a 12-month, 18 depending on your product strategy, the product roadmap, right? That defines your business. Right? There's nothing like a single black story. And investors understand. And where the cash is spent, like if cash work, as I said, if it is purely on the product, purely on solving the technical debt, purely on adding much more richer features to your product, absolutely fine. Even the 18 months, the investors say, last time I talked about 18 months, now it is going to 4 months, 2 years. But the cash burn is growing is because you hired a smarty office or right, you are spending because you do not know compliance well and you have to take analytics or whatever, then so it depends on what you do, what the cash burn.
Any questions, guys? What percentage of your AOP should be a marketing? Or let's say, when as an institute product, what should be a marketing?
I'm not an expert. I work with a couple of but I can't exactly sure how it falls into the product research. As far as service industry goes, from a sales and marketing perspective, is about 6% of the budget, right? Where I think marketing can be 40% and the sales can be 40%. But product is also cost. Product obviously is much higher. Like especially a SaaS product, can go back as high as 40%.
At least 1 month. So, any questions? Mr. Yeah, one of the teams is what is quantum teams. They are not relationship. They talk about lending without collaterals. Right? So, what is your, what do you think?
So, yeah, somehow I still have a very negative view about this show. I still think maybe I have not read enough positive things or whatever. So I have a very negative view about that. I think currently it's on the driving on association. In my mind, I want I have a very traditional approach to it. I think crypto can be successful provided it is backstopped by a central bank or a regulatory authority assets, right? So, unregulated crypto that can ban countries without a regulatory oversight, right? I'm still not digesting my thought. What is there any follow-up question? I think this might you on crypto. So, will that avoid taking the question?
Not too bad. I think very few companies are there talking. But we do see a shift to happen. A lot more people are now financing sector. We are seeing a lot more new models of lending is coming. One of this are more than that, it is also a tech that's changing the way the outlook. Government should actually adopt.
I know. Just to add to the point, see, the success of UPA in my mind, right, pretty much validates my theory as to why I should seek an alternative currency like crypto. When I can do digital transactions across the country, right, and actual money is getting exchanged. Right, I see tangible money getting exchanged in a digital platform. So, I guess crypto was planning to solve this issue. That is, the issue is already problems already solved by universal adoption across the country by UPA of UPA. So,
I think crypto may solve issues which has faced. Which is the central economy not able to control their finances, right? Which is then what I'm coming to is maybe an ordinary investment, maybe to the richer, right? But on the long run, like you could see the control of the government today. That's what I can see. Countries have started playing with money, with cash, with the banks, printing money as and when they want. Do you think these could actually be solved by something like crypto, which is giving more global currencies out, controlled by people?
No, to be honest, I don't know the answer. As I said, I have a pretty single view. My view is probably a little more biased also that way. Right? I do not, in fact, I spent some time with you guys to understand. Maybe it will change my thought process on that. Right? But I have a very cynical view, so to say. Sad to say that, but of this point, willing to change.
On one thing that last week on share course investment. How do you manage your business? How do you get those
Yeah. No, this is a very, very important area for strategy. A lot of companies get mired in controversies. In fact, my past companies are not now, but the big old that they were 10 years back got into use for this whole promoter, shareholder kind of company. Right? I think it's very, very important. See, as promoters or founders, I think that's where I think it's ultimately a way of emotions. You need to, I think founders are genuinely emotionally attached towards the product or the brand or the company that they are building. But please remember, when you are giving out equity, when you actually taken on other person's cash, and obviously helping the company to grow. And once you do that, that you are also are fiscally responsible, right? And that's where it becomes important as a promoter to make sure that there is equal stake for the investment of the shareholders in managing the business. And that's where the letting go has to act. In fact, does not mean letting go of the whole business. You have to understand that somebody has not equal stake in the business, right? They have skin in the game, right? The shareholder that is money has got skin in the game. And obviously, whether it is fiscal prudence or even business decisions are over the business. So as long as that you are aware to the fact that it can be avoided. See, documentation, etc., fairly straightforward. It's all, I don't know, proven in time, right? Guardrails, make sure that as a founder, as a initial investor, you are you can make sure you write enough legal language to make sure that is covered. But at the same time, where generally happens is because as founders, I mean, generally we exhibit a lot more emotional attachment to the company and the incoming shareholder.
There's a lot of case studies how companies have avoided that. For example, a case in point, companies homegrown in India, that they are promoted by first generation went ahead, raised money globally. How they become beacons of investor confidence, how they adopted good practices in investor and shareholder management. There are enough things case studies. It is not easy, but I think the key thing is to keep your emotions up. In my mind, I was part of, I was actually the CFO of a decade back, fight between promoters and shareholders. We had an inside view of that, and my view was purely an emotional one. And of course, I need to also have the fiscal discipline, the transparency, especially with the has to be there. But that can cause serious credibility issues and can affect the business. Ultimately, as promoters, we also have name credibility, right? As you kind of grow, you also grow in stature and also name credibility that you bring to the business. That will all collapse if
Anything else? Okay, thank you guys. Thank you Sundar for
thanks,
Sundar, and thanks for the session. Puneet has added a new prospect to his prospect list. He's going to sell it to PBL and Coke also.
But it's been my pleasure. See, as I said, this is a big audience for me as well. It's easier to speak in the boardroom or corporate